Rohr here with an early global view at 6:30 a.m. on Thursday, October 30th, 2014. And it's important to note that after there was little data that was mixed yesterday on Wednesday, of course we hit the FOMC announcement, and the statement was a bit more hawkish than people expected. So what does that give us on the short-term view of the S&P 500? Well, the answer is that this market, hourly chart on the left, 30-minute on the right, is already down $12 today, trading at 1960. And that's very important because it shows the degree to which that after the late session recovery yesterday, the market did not want to get back above the 1975 to 78 resistance after hitting that key old high from back in July before that spill out of late July into August up at 1985, that it couldn't really sustain it yesterday. And this is one of the key targets that we had once the market crossed above 1900, especially gapping back above it, going back to last week Tuesday. That signaled the crisis from the previous week was over, and the market, even if it was topping, could range well back up toward the upper part of the previous range around 2000. Of course, we also need to note that we still have the negated down break and gap back down around 1957.5, and the gap is actually to the close back on Tuesday at back on Monday at the 1957.10 level. And of course all that is a buffer before the market even gets back down to the more important 1955 to 50 congestion that we have looked at repeatedly, and the 1945 tolerance of that support is reinforced by the early low from the dip on Monday prior to the market getting the bid back into Tuesday, and that's really pretty much it. If it should break 1945, then a reversion back to the lower support in the 25 to 20 area, also reinforced there by the gap, which was the gap up out of last Wednesday into Thursday of the 22nd and 23rd, is right at 1925. And once again, that has a tolerance, and it happens to be the trading low here, back at 1920 to maybe 18. The bigger support, of course, can be down in the low 1900s once again, which was the gap up back in late April that set the market off for the run-up to 1985 initially, and now we have another gap up right from the 1900 area, along with some important Fibonacci support. So it's all going to be very interesting on the downside, and if the market should try to rally after holding any of those supports, 1975 to 78 and 1985 are the key resistances still. And that pretty much does it for the short-term view of the S&P 500, except to note that if the market stays under pressure at all this morning, this short-term hourly MACD that dipped back below its upper runaway band on the weakening yesterday obviously will reinforce the weakness by remaining below it. And that's pretty much it.